ففي البداية السلام عليكم جميعا، بارك عليكم الشهر، كل عام وانتم بخير. سعيدين جدا بتواجدكم. We are delighted to host you here at Sukuk Capital. Today's panel will bring from audience and the panelists different and various stakeholders in the ecosystem. And please let me first introduce our panelist, أسامة العويضي. أسامة العويضي brings over, mashallah, 18 plus experience in investment management experience, starting first in likes of GIB Capital, S&B Capital, Samba Financial Group, and co-founding regulated asset management firm. We're happy to welcome you, Osama. Thank you for joining.
You're welcome. Thank you for inviting me. I look forward for a great discussion with you.
إن شاء الله.
كل عام وانتم بخير جميعا ورمضان مبارك على الجميع.
يمكن we want to exploit the fact that we are in a small venue. So at first, please pass on the mic for everyone to introduce themselves, stating the name, the entity they're from, and to explain why are they keen to join us here to discuss or learn more about private credit.
الله يحييكم جميعا. أنا عبد العزيز السياري، رئيس تنفيذي شركة سكوك المالية.
السلام عليكم، مساكم الله بالخير جميعا. عبد الله بن عمان from the city.
السلام عليكم جميعا. وليد إسماعيل، أنا أعمل كبورتفوليو مانجر في صندوق الاستثمارات العامة، وجاي هنا للاطلاع على برايفت كريدت وتعلم من أبو سعود. new asset class or emerging asset class.
السلام عليكم جميعا. براء أمير، شركة جامس هندرسون انفسترز، اكزيكتيف دايركتور معاهم.
السلام عليكم جميعا. محمد بن صالح من الراشد المالية.
محمد الحضرمي من أول الاستثمار، مدير محاور.
بشاير الريش، هولدنج في الانفستمنت.
ريما الغنيم، مدير تسويق بسكوك المالية.
هلا وسهلا. عبد العزيز العايد، ماسك الهولسيل فاندنج BSF، واليوم I'm representing CFA Society.
السلام عليكم. سعود المكتال من الإنما كابيتال في الإيكويتي ريسيرش تيم.
فهد كردي, Head of Investments and Wholesale Funding at BSF, and I represent CFA Society.
مرية Investment Banking at سكوك.
نواف رشيد، مدير إدارة الاستراتيجية سكوك.
رحمن المهيدب، Wealth Management سكوك كابيتال.
السلام عليكم. محمد المغيرة، Investment Bank Department سكوك كابيتال.
Hi, this is Kema. I'm from SEP Invest, working as a Vice President in Quantitative Strategies. Looking forward to learn more about the private markets.
السلام عليكم. كريس أغابي، سابقا من ديلويت وحاليا في transition period. We're looking forward to this exciting session.
Hi, my name is Prashant. I work for a small family office in Riyadh. I'm keen to learn private credit.
Myself, Muhammad Bilal. I'm from Al Raji Group. Thank you.
Assalamu alaikum. Abdullah Mubarak, Investment Banking from Sukuk Capital.
Assalamu alaikum. This is Doru Kadhan. I'm the Head of Asset Management with Razeen Capital. And the reason I'm here today is to explore this private credit because we have a lot of clients for whom we keep looking for fixed income securities, and we face this challenge. So I'm really looking forward to some new ideas and all of this. Thanks.
Assalamu alaikum. Mohammed Athman from SEP Capital Private Equity.
السلام عليكم. مسعود المطيري من S&B Capital Multi Asset Investments.
حياكم الله. Thanks عبد العزيز and Sukuk for hosting us. This is Sohib Sawadi. Looking forward for the discussion with Sukuk.
السلام عليكم. أحمد بن محمد الشهيب، شريك مؤسس لشركة معاملة الاستشارات العقارية، أول شركة مرخصة للاستشارات العقارية،
وشريك مؤسس لشركة إبرام لحلول التوثيق الملكية العقارية، ومستشار قانوني لعدة شركات في القطاع العقاري، مستشار قانوني كذلك للقطاع الحكومي سابقا لدى عدة جهات حكومية.
السلام عليكم، عبد الله القحطاني من فريق تسويق في صكوك مالية.
السلام عليكم، أسامة المهوس Wealth Management Scope.
حياكم الله جميعا. Welcome all. Maybe to first start this panel, we want all of us to be aligned on the idea of private credit as an asset class. Abu Saud, if we can define private credit as an asset class before we get into the whole dynamics of the market, just a brief, simple definition of private credit. What are the products engaged in that asset class? Who are the likes of investors that would actually tackle and penetrate that asset class?
طيب يعطيك العافية. طبعا let's start with what is not private credit. First, bank lending is not private credit. Bonds, sukuk traded in the market are not private credit. Syndicated loans are not private credit. Private credit are usually loans extended by non-banks to borrowers on a bilateral negotiations with features and covenants that are tailored and bespoke for each transaction. Private credit is not tradable, so it's securities that are usually investors hold to maturity, and it is a high yield and therefore high risk instruments. Usually the type of returns investors look for when they go into the private credit space in our part of the world is in the mid to low teens, while the public credit, large companies, you're looking at around 5 to 7% depending on the risk profile. So there is a liquidity premium embedded into the pricing. There is a credit risk premium embedded into the pricing, and sometimes structuring and special covenants and features embedded into the pricing.
In our pre-panel discussion, you have elaborated the whole story of private credit from a global perspective, and it is very fascinating to understand how actually the private credit have been established globally and where it is right now. From a global perspective, how did actually private credit, from structural conditions, enable that private credit or enable that asset class?
To answer your question, you're asking about global, and I will answer that and then answer what is happening locally and the dynamics in the local market. So globally, in 2010, private credit outstanding was around $500 billion. Currently, yesterday when we were talking, we thought it's around 1 trillion. With more research, it's actually at the end of 2025, if you take all privately negotiated deals, senior secured, distressed debt, real estate development financing, and infrastructure private credit, you're talking about $1.8 trillion. So from 2010 till end of 2025, you have massive growth. That growth, the catalyst for that growth were actually two major catalysts. One is regulatory and the aftermath of the financial crisis, and another is the search for yield and returns. After the financial crisis, there were a lot of regulatory changes in Europe and the US, restricted banks from extending loans to high risk borrowers. And usually private credit in developed markets largely sponsored loans, so LBOs that are PE-backed transactions, and you have a small segment that is non-sponsored, which is the non-sponsored is estimated to be around 30% of the developed market private credit space. Of course, we're not talking about leveraged loans. We're not talking about broadly syndicated loans and other maturer segments of the market. So the 1.8 trillion we had in the US, for example, we had Dodd-Frank, and we have the TARP bailout that a lot of banks received. And these came with restrictions, restricting banks from extending loans to these high risk borrowers and increasing the risk weighting on these loans. So they became non-economical and also very high, require very high capital allocation by the financial institutions. So the asset managers like BlackRock and Apollo and other major players in the space capitalized on that opportunity and took all these deals that are viable, especially after the financial crisis, where assets were very cheap, financing was scarce, and they could dictate their terms and covenants, and the industry just took off. And you had also at the same time almost zero interest rate environment. So the pension funds, insurance companies, in order to generate the returns that they require on investments, had to also go up in the risk curve and allocate more of their investments into the space. And given that we had around 15 years of relative stability from a macroeconomic perspective, apart from the COVID crash, where we had a very quick rebound due to the aggressive and proactive responses by governments around the world. So the space didn't go through stress. So going from 500 billion to 1.8 trillion, we didn't have a major credit cycle to test the space. And incidentally, today there was a news article on Bloomberg where one of the UBS, a major Swiss bank, published a report saying they expect defaults and credit risk to reach as high as 15% in the space. And during a down phase of the cycle, which they expect that we are just starting. Currently, they estimate it to be around 3 to 5%, which is much lower than the historical average over the single cycle that we have. So statistics are between 70 basis point of average loss rates in the space over the past 15 years. So now we are double that. We're much higher, or actually triple that, per the article, and expected to increase significantly. This is why you should invest in Saudi, in private credit. The space in Saudi is totally different. We are starting from a totally different place, and the catalysts are different. The first catalyst is regulatory, where there is regulatory clarity and support by SAMA and CMA with all the regulations. Both regulators are promoting non-bank financing and direct and indirect lending from the CMA side. Second is the crowdfunding digital platforms like Sukuk Capital, which solved a very big problem. And the first time we met you guys in our office, I didn't want you to leave because we were struggling with origination, and you just solved that for us. Of course, people who invest directly with you, they have different requirements, ticket size. For our investors, it's totally different. Scale matters, and you also solve the scale problem for us. So digital platforms, either in the SAMA bank umbrella or the CMA umbrella, solve the origination problem for people like us. And investors' appetite is also very strong. People tested the space personally with the small tickets directly through Sukuk, through Manafi', through the other pioneers in the space. And when we launched our strategy, it was very easy. The other vertical is the venture debt side, which is growing very fast in Saudi. Maybe just a data point. In end of 2010, credit funds and credit asset class in the industry was around 800 million Saudi riyal. Now we are at 7 billion as per the latest data from the CMA. So the industry grew massively. Private equity was around 10 billion, now it's 33 billion. So there is massive room for the space to grow. Honestly, the opportunity is massive. We're just starting. So if it's globally 1.8 trillion, we're at 7 billion. There is massive growth opportunity there. The venture debt, we are around probably 300 million. So there is also a massive opportunity for growth. So all these together created this opportunity. And of course, there is the middle market, where Mohammed knows very well. But the middle, we had a lot of opportunities coming to us for middle market deals. The problem with them and why we don't like them, they're heavily concentrated with one issuer. So basically, the fund is a single issuer. And this game is about diversification. You need to invest in large number of deals so you get the average. You get your 13-15%, and over the medium long term, you get your 3 to 4% default rate. But if you invest in a single deal, you either get your and these middle market deals also not attractive from return perspective. They're in the 8-9%. And you get all the credit risk with a single issuer. So we're still not active in the middle market space, in the SME space where we collaborate a lot, and the venture debt space. We're also very active where we see opportunities. And investors understand the risk, understand it's where it fits within their portfolios. And there is a lot of money that can be deployed, but the funnel and the origination constraint, that is, again, you guys are working very hard in solving, is a very critical bottleneck for us to grow in this space.
With that being said, is it fair to say, having understood how private credit actually rose globally, if I were to put it in Saudi market today, would we say the past 2 years we have been hearing private credit as a new trend, as a new asset class, although it has started a while ago, but the real picking up of private credit has actually been 2-3 years back. So is it fair to say right now private credit as an asset class is mainly established when an economic downturn is happening, therefore it will solve, or it will bring a new alternative financing solution? And correct me if I'm wrong, is it fair to say also that due to the banking constraints right now, due to liquidity conditions in the market, this is the real reason why private credit has actually, or we have been hearing private credit in the past 2 to 3 years?
So I think it's, so if you think, look at it from global perspective, because the returns are very high and the asset class grew massively, this is why it's in the headlines. Because if you think about it, you when the growth cycle in the asset class started in 2010, you had the predecessor of SOFR around 1%, and the spread over that is 500 basis point. So you're generating around 6%. And when interest rate increased, they started paying their investors around 10%, and everyone piled into the space. Given also that private equity haven't been doing very well, but now at 1.8 trillion, it is an asset class that would stay. Probably the catalysts are the regulatory catalyst and the low interest rate environment, but the level it reached now, it is a legitimate asset class. The question, will people perceive the how will people perceive the downturn is very important. A lot of people understand the risk in the space, but also there are a lot of people who market it in a misleading way. They do not highlight there is no free lunch. If you get 500 basis point above SOFR, definitely there is risk. There is no free lunch. If you are getting 14% in our local context, definitely there is risk. But that is risk is can be taken, because at the end of the day, if you compound at 14% and then you have a down cycle where default accelerate, you would survive, because the returns that you accumulate over time will give you a very good cushion, and the cycle will resume. But look at banks, for example. Banks currently, the cost of risk is around 30 basis point on the sector overall. Long-term average cost of risk is around 70 to 80 basis point. So how do you get to that long-term average? Is by having certain periods of the cycle where cost of risk is 2 to 3%. And you would get there. That is inevitable. It will happen. We will have credit cycles are just as natural as the air we breathe. So we will have these boom and bust credit cycles. We will have these phases where cost of risk is very low and there is complacency, and then we'll have phases where cost of risk gonna accelerate and increase due to defaults. And that is why you're paid the spread that you're paid. And this is why maybe I have I believe that probably fixed income, some people think about it as an asset class where returns are guaranteed. Yes, they are contractual, but there is always that possibility of default and restructuring and bankruptcy. And now in Saudi we have very strong frameworks around this, and globally in private credit space, you would have these episodes where private credit lenders will go through these bankruptcy process with the companies they're lending to. So there is no free lunch, and but the space proved to be very important component of investors' portfolios. It provides excellent diversification benefits. Its correlation with public market is very low. However, volatility might be dampened by the valuation cycle of these private market instruments, be it in the private credit space or the private equity space. But they would still have certain exposure to economic cycle and economic conditions in the countries where the private credit players are exposed to.
And from your point of view, and with that being said, as an asset manager, would you actually consider private credit as a tactical position to enhance some kind of yield or a permanent market layer that asset managers should actually consider? And perhaps a follow-up question on that is usually private credit used as a yield enhancer or a diversification tool?
It depends on the investor. If you look at the retail, high net worth individuals, it is opportunistic. And they usually operate in an opportunistic way, given what's happening with the public equity market, what's happening in the real estate market, especially in Riyadh. People are looking for alternative investments, and private credit is a great place to be in this phase of the cycle. But for institutional investors, very sophisticated investors, the way they operate, they have strategic asset allocation. Strategic asset allocations, historically, very traditional institutions would have what we always call the 60-40 portfolio, equity and fixed income. Fixed income being the public fixed income, bonds, sukuk, and some money market exposure there. But then you have people evolved into much more sophisticated strategic asset allocation, where you have equity, then fixed income and alternatives. And people used to put everything that is not public equity, not fixed income, under the alternative umbrella. And it used to be mainly real estate and private equity. Then you have things evolve into explicit allocation to private equity, explicit allocation, especially with the David Swanson and the endowment model that he pioneered. Private equity became a very important component of asset allocation, and real estate, then alternatives, where you put everything, including VC. And now it's very hard for me to actually think about any serious asset allocator not thinking about private credit as a strategic component that is explicitly mentioned in their asset allocation. Will it become as large as public equity or public fixed income? No, but it will have its distinct position within the asset allocation because of the diversification benefit it provides. And it provides also good diversification benefits and an alternative for PE. Because if you wanted to play in the space now thinking about it from global perspective, where LBOs and PE funds are active, you would go for the equity side traditionally. But now you have the alternative. You could either invest in the equity or invest in the private credit of these transactions, and that creates efficiency in capital allocation. It creates efficiency and opportunities also for the diversifying source of financing for the participants in the economy, from corporates to real estate developers to infrastructure projects and so on.
I would actually totally agree with you. As a matter of fact, I was reading an article about different alternatives, and what caught my attention was private credit. If I were to come at a very simple number, which is Sharpe ratio compared to other alternatives, it was actually the highest compared to PE, compared to other alternatives. And that actually leads me to a question. Now, you mentioned private credit has reached 7 billion as the latest data. What do you think the main reason? Yes, what do you think the main reason behind not scaling up at a larger number? Is it usually, or would you see it from your point of view due to suppliers, as in providers of opportunities, or borrowers, or asset managers are hesitant to tackle that asset class? They're waiting for a track record to be shown on that asset class.
I will speak about our own experience, and you can generalize it. We raised around $100 million. We could raise $1 billion, but deployment is a problem. Origination, the funnel is not mature yet, especially when you are very disciplined around the ticket side and the diversification requirement. Yes, I can raise $1 billion and deploy it with Muhammad, 5 deals, and then hope for the best. If one blow up, I lose 25% of my capital, and no one will be happy. But we want to be very diversified. And that is why we're raising capital very slowly. Hopefully, once we finish deployment of the 100 million we raised, we go back to the market and raise more. But we wouldn't rush into deploying, because we have that very strict diversification and single exposure limit. We think it used to, by the way, the industry used to be called shadow banking. And now it became private credit. So you think about it as a bank. Actually, when I started my career, I spent at Samba Financial Group a short stint in rotation, and part of it was within the corporate bank. So I have good understanding how corporate banking work and how credit is extended. Banks are all about diversification. I don't know what's the last number of the total lending by banks in Saudi. These are very diversified pools of portfolios. You always have delinquencies. You will always have banks. Actually, I don't know on which floor in our building there is a remedial team, because there are defaults, there are delinquencies, there are. But you don't see it because banks are super diversified. And that is what a good private credit fund manager should be, requiring this diversification. And we're blessed with the relationship, honestly, with you guys. You are enabling us to diversify and have. We're diversifying across not only issuers, and also across vintage. So we're deploying gradually. We don't want to be only exposed to the quarter one or Q4 2025 vintage, because I'm sure those who are familiar with the private markets, and especially in private equity, the performance within vintages are very highly correlated. So you want to diversify across vintages and over time. So that is probably why it is taking time to grow. Another major reason, very large private borrowers in Saudi. We would love to participate in infrastructure deals for projects like Qiddiya, Neom, Murabba, in the aviation space, soft and hard infrastructure. The problem with a lot of these issuers, their expectations are not in line with market prices. They're anchored at the level that the Ministry of Finance or the central government or the PIF borrows at. While the risk profile is totally different. The nature of the projects are totally different. So we see that there is an opportunity, but expectation gap is also preventing us from exploiting opportunities there. يمكن محمد يتذكر when he was at HSBC, we used to talk a lot, and a lot of opportunities come from that segment of the market, but they're very hard to close a deal there. So that is another probably reason why the space still not taken off.
Before actually we get into structures or how to operate such a structure, from an investor side, if we would bring the conversation to the investors, who are the likes of investors who would actually go to those asset managers who enable private credit? Are we talking about high net worth usually, or corporates, government entities? Who are usually focused more onto that private credit?
All of the above. يعني for us, we have a very diversified investor pool. Endowments, the charity endowments, insurance companies, high net worth individuals, and a segment we called high earner but not rich yet. So the 100,000, 200,000 riyal, the segment of the market. So it's very the space appeals to a wide range of investors. But the most important thing is education, because sometimes people think it's a free lunch. They're gonna get the 10% number for Saudi, and a lot of investors around the world is the magic number. If you can get them anything 10% or above, they would be excited about. But they need to understand the risk. The risk classification is transparency around risk, and risk classification is very important. And we believe that people understand very well the risk, but education continues to be very important as well.
If any bad إجابتك, would you say investors, especially high earners or high net worth, are, if I would put a weight on how sensitive they are to pricing compared to the risk? You said the magic number is 10% and above. Would you say that, because from our side at least, in Sukuk Capital, we see that when it comes to, there are two main factors. First of all, pricing, and you mentioned 10%, maybe in our case, not, it is more on 12% is the magic number. And on duration, yes, they are very sensitive to duration and long-term opportunities. From your point of view, especially doing a very remarkable job on your private credit, would you say they are more into price sensitivity or they are focused more towards risk and diversification?
I think it's a balance between the two. now when you look at the market and think about the opportunity set, it's very hard to generate that level of return in the regional context and globally as well, honestly. But for us, we need to be very disciplined, because when you think about the 10% or the 12%, you need to maintain it over the cycle, because you will have a down phase. So on average, you need to be able to generate your 12%. The fund need to generate its 10%. So during certain phases, we would have higher than that. During down phase of the cycle, it will be lower than that. But as long as you can maintain the average, it's very important. Then price discipline. Now, because there's a lot of capital chasing these opportunities in the market, and that is in my previous answer, I said it's not a problem of availability of capital, it's availability of high quality, scalable opportunities. And I don't want us all to get into that race and competitive, unhealthy competitive practices where pricing becomes not disciplined.
Mm-hmm.
We have to think about the return stack. You're starting from 5% where you would generate on your deposit. If you put your money in a bank deposit, you get 5%.
Mm-hmm.
Then if you go for longer tenor, so you get the term premium. طبعا فهد كردي أكيد is the expert.
Mm-hmm.
Probably we're talking about 50 basis point to 70 basis point additional return. So you get closer to the 6%. Then if you are a large corporate, large conglomerate, non-government, of course, you're talking about another 100 to 200 basis point above that. So you get to the 7-8%. Then you add additional risk premium for the SMEs, for the private credit side of the market, because they're smaller, higher risk borrowers, and at the same time they are bespoke transactions. So there is structuring a premium as well. You would add to that around 300-400 basis points. So you're now at the 10% level.
Mm-hmm.
Then you add the illiquidity premium, because these are illiquid investments. You're not buying a 2 years bond or sukuk that you can sell whenever you need the money. You will add another 13 to 14%. So that is the starting point. We shouldn't go below that.
Mm-hmm.
And I see how you price your deals, and the minimum is, from credit perspective, is what I alluded to. So the 13 to 14% is where you get started. Then you can add on top of that. Then there are the frictions in the system, not the friction, but the intermediaries, fees, and all of that. What you take, what we take, and then what the investors would net. So on your side, investors would net around 12%, 13%. And actually, before we got into the professional and arrangement with Sukuk, I tested with my own money, and then all of a sudden you showed me that my portfolio is unsustainable.
Yes.
And I hate. I love the returns, but I don't like to see that when I go into the account. So it's I'm getting around like 14-15%. So the highest risks. So we'll see how they would unfold. I'm getting my money on time, so it's performing very well. But then if you on average you net 12-13% at your layer, and at our layer we would net around 10.5-11% to our investors, and that would keep the industry going, will keep investors compensated very well for the risks that they're taking.
You know, since it is still as an asset class in the growth phase, and you cascaded and broken down the pricing, and actually this is somehow similar to the pricing we conduct in Sukuk. But since the market is still in a growth phase, would you be concerned as an asset manager that pricing, due to competition, due to increasing size, would actually correct itself and somehow be minimized?
You mean the prices would go down?
Yes. And to what extent is the risk-free rate or cyber do you think is correlated? Does it have an direct effect on the pricing of credit opportunities?
It is the starting point. I mean, if you can ignore it and you can take it into consideration. If cyber go down to 2%, so the whole curve will go down by 2%. So it's a very important component, and you can take it explicitly or implicitly, because that is a lot of investors would start from there, and will ask, so why would I go into this investment at the higher risk? And the reason I have explained it and talked about it very transparently, and maybe in more details than how I should, is because I want people to really keep this in mind and not enter into this competitive spirit and push prices down to a level where, if we have a downturn in the cycle, probably if returns are much lower than how they are, just like what's happening in the real estate market, we don't know where it's going to be. But if you bought a piece of land, 33,000 riyal per square meter, I mean, you really bet a lot on good luck rather than sensible aftermarket, the leasing market, what is justified in leasing markets. And I remember I used to have similar discussions with people in real estate space, and I tell them, like, okay, 33,000 riyal square meter. Now the building is developed, it is residential or commercial. What is the yield to the investor? See, no. This is not for renting.
Mm-hmm.
This is for selling. So and because prices will go up, that the IRR is attractive.
Mm-hmm.
So these not for sale, they're not for lease projects, and the feasibility studies that we used to receive during 24 and early 25 are all based on selling at higher valuation and prices, because everyone agreed it's the prices and valuations do not make sense based on from leasing perspective, but ultimately it's going to be leased. Mm-hmm. That is and ultimately the home, if it's a homeowner or apartment, or the final owner will think about it from the opportunity cost. Do I lease or own? Mm-hmm. That is how it would be. It reminded me of a story Walid knows very well. There was I don't know, in the 1900s, a speculation about sardine in cans. And one, I'm not sure if it's a myth or it's a real story. Mm-hmm. One guy said, This is spoiled. These sardines are spoiled. They're very old. So why the price is 20, 30x the value? And actually, the value is zero. So no, this is not for eating sardine. This is for trading sardine. So that is probably is a similar analogy. So if prices in the market keep going down, they will reach level that they wouldn't make sense to the investors. And when you have downturn, it will become very severe, and then we'll have very hard time to get investors' appetite back to the space. So price discipline, I think, is the responsibility of all of us players in the ecosystem.
Covering the whole establishment of private credit, reaching then to investors and who are the likes of investors. Now, let's say an asset manager would like to tackle that asset class, start private credit. If you look at the markets globally and locally, usually private credit is focused towards direct lending vehicles, and there are other options as your strategy in SAP. If I would go to the other options, from your point of view, what are the risks, the operational risk of handling the whole origination, execution, monitoring, and then collection, the whole operating mechanism? An asset manager would typically, with the different asset classes, public equities, private equities, real estate, or alternative investments, would actually be an asset manager investing into that asset class, acting as a project manager onto those assets. If the asset manager would go to the private credit as a direct and the lender of record, the whole business would actually differ. There is actually an operation ongoing. From your point of view, what are the risks being that asset manager and this asset manager?
Probably we touched on this from a different angle. What a lot of asset managers are doing and have been doing is single bilateral deals because of the operational and servicing challenges if they are very diversified. So they would just deploy 100 million, 200 million in one transaction and close the fund 3-5 years, then return the money to the investors. And the reason they're doing that because of the operational challenges. I think there is an opportunity in the market for servicing and agency servicing for private credit to enable deployment and diversification for asset managers. But what we found as a solution is to collaborate and partner with platforms like you. So you originate and you continue to service. We do our credit assessment on what you show us, but the origination and the servicing is done at your level. So everyone will need to find the solutions. I know HSBC provide servicing services, but they would provide for large transaction and large loans. They might not be very keen to do 200 middle SME servicing, even if they're going to be paid higher amount because of the system and operational requirements. But that is what you didn't intend to build your business that way, but it was an opportunity, and we took advantage of it, and we'll continue doing that. We will never be taking the servicing and the operational activities apart from fund related operational activities, not the asset specific and the loan specific or the sukuk specific activity will always stay with the originator.
Mm-hmm. You mentioned at the beginning of the discussion started off with $100 million fund, and you expect to increase that. Usually, dealing with the likes of sukuk, at least from our side, the opportunities we provide are like usually held to maturity. Still, the market is not seeing much liquidity on the selling. So, having to deal with such open-ended vehicles or funds and dealing and investing in securities that are at least facing liquidity gaps, at least till now, how did you actually manage to work your way out into that asset class?
Yeah, by asset allocation. First, we stack the portfolio and allocate it based on our expectations of capital flows, just like what we do with the money market. By the way, money market funds are open-ended, and we have placements up to 12 months,
mm-hmm.
and their daily liquidity, by the way, the money market funds. And the average duration can be 6 months, can be 90 days, but we always position the portfolio in a way that enables us to meet the liquidity requirement. We also, the funds can borrow. So if God forbid we don't have enough liquidity at the fund level, we can always borrow. We can always to meet these short end, and the amounts that investors could redeem have certain limit on them and gating that also enable us to manage and not be in a situation that would result in a very large amount of redemptions from the fund.
Maybe as a last segment for our discussion, from your point of view, on a forward-looking perspective, what do you think needs to change in order for that market to actually evolve and reach to at least what you're expecting it to reach 5 years ahead of that?
Okay.
What needs to change from infrastructure, investors' mindset, opportunities, suppliers, foundation of that asset class in order for that asset class to actually evolve and scale up? At least in our case in Saudi.
Yeah, I think it's we continue along the same path of improving the quality and diversity of origination channels, maintaining integrity and high standard when it comes to pricing. Credit assessment is very, very critical and very important to remain robust and very strong. Probably banks' participation in co-financing and being more open to co-financing opportunities is within the SME side, and banks could become originators actually, and that is an ongoing discussion we have with several banks, because one of the reasons why you have a lot of SMEs, high quality SMEs coming to you guys, because the banks are unable or unwilling to finance them. But banks could actually originate these transactions, warehouse them, and sell them to private credit funds, or securitize them into sukuk and bonds, portfolios, or CLOs and other securitization vehicles. and sell them to asset managers, to insurance industries. So banks probably are going to be very critical in playing a key role in getting the growth that we aspire for in the industry. Other is private equity, because globally private equity players constitute 70% of the private credit market, which are what they call the sponsored deals. Private credit now, they go to large syndicate banks and large and investment banks to raise debt for their deals. And in Saudi, a lot of them are still highly equity financed. Globally, private equity sponsors, they want the largest financing because they want to minimize their equity piece. They want the largest and the highest level of flexibility, so they can ring fence asset and have some fallback scenarios if things go south, and the lowest pricing. And they're getting it from private credit investors. I think as the private equity industry mature and grow, Jadwa raised their first blind pool fund, and there are a lot of other players trying to grow into this space. If they also play it with a mixture of equity and debt, and source this debt just like global private equity players from the private credit market, it could fuel growth. يعني شوف الحين the private equity is 33 billion riyal private equity funds, so these are equity funds. They could be easily 15 billion debt and 18 billion equity. And that is much more optimized capital structure than 100% private equity.
Actually, we passed our time. I was just watching the clock, but if you allow me to close the discussion with a very simple question. You have done, Abu Saudi, a remarkable job in your private credit activities. What is the secret sauce for asset managers to actually learn from that experience?
Well, it's to be open-minded, to collaborate. يعني احنا our secret sauce is collaborations. We collaborate with you on the SME side, and that collaboration enabled us, because we're investing in securities, enabled us to create a unique structure. We collaborate with private debt managers, co-financing through dedicated funds where we could come in when the deals make sense for us. So collaborations are the key ingredient, honestly. And we're doing it. We're working on a pre-IPO fund, and we're also doing it through collaboration. We're not doing it as a single deal. All the pre-IPO deals that came to the market and our competitors have participated in and underwrote came to us. But our vision is to have a diversified and a scalable strategy, not a single deal strategy, just like what we did with you guys. We collaborated with several players with sizable pool of IPO ready tech-enabled businesses, and we're starting the fundraising for it this week. So collaboration is the key, and we don't see it as a competitive environment when it comes to the fintechs and the upstarts in the asset management industry like you guys. We see it as an opportunity to collaborate and work together and bring to our investors something unique that benefits them and benefit the ecosystem.
I agree with that 100%. I want to actually pass the discussion and questions to the audience for 5-10 minutes. Please, if anyone have any questions, please raise your hands. I think Abdullah, you have the microphone over there. And the microphone معك.
Really thank you for this insightful discussion. Where is the credit rating in the equation of this? Do you see it playing any part in private credit?
Well, maybe I missed and I forgot to say it, but very critical. Now, just recently, over probably 3-5 years ago, Moody's and S&P and Fitch started to rate private credit in developed markets. I think it's very important. Credit rating is super important, and that is an opportunity. So probably origination and servicing, and probably credit rating for private credit. I totally agree with you.
My question is about difference between cash flow backed private credit financing of investment and an asset backed private credit investment. How do you see that difference in the credit risk?
Well, it depends on the quality of the asset and the quality of the cash flows. So the private credit, very important to look at it deal by deal, because every deal and transaction is different. So sometimes cash flows are of a higher quality and much more sustainable than an asset that is tangible but might be overvalued, might be not in good condition, or could deteriorate very quickly if it's a factory or if it's a building. And the other way around, if it's the cash flows are not sustainable and from a very cyclical business, a business that doesn't have stable and high margins, so margin stability is very critical, then they're not attractive. So it depends on the transaction. And most of we in the venture debt, for example, it is a lot about the potential and the expected cash flows, because usually these are technology enabled businesses, very asset light. So you have to think about it from cash flow perspective rather than asset perspective. Real estate development and real estate deals are usually asset backed, and the asset play a much more critical role than the cash flows. But the exit is what is important, because you will get paid once the asset is sold after completion.
أول شيء أشكرك أبو سعود على هذه الجلسة. So my question is that you mentioned that the catalyst for the private credit was the low interest rate environment, and I would like to give some just about our experience when we started. We started at a very low interest rate environment. environment, and it was 8 and 9% was 8 times the deposit rate. So there was a huge demand on investing from high net worth individuals. Then after the increase in the interest rates, we reached to an average of 5%, which we have now. The difference is, I would say, 2.2. Yeah, so it's 2.2x or 2.5x from the deposit rate. So and you mentioned that we have the rate should have this. I would say we should have these rates ongoing basis later on. I know if we take the default into consideration, the default have a different methodology. So it's 7%, 1%. This means in the default the declining, and the rates is very, very high in the net rate. So how do you see with expected declining interest rate the proportion between the interest rate or the deposit rate and the rate that is net to the investor and private credit?
هي في fixed income generally you have the component of returns are the prevailing rate in the market, so what investors expect to get by taking very, very low risk. You can use the Saudi government 10 years or 5 years bonds. You can use the deposit rate with banks. And in the private credit, usually globally, they start with SOFR as the starting point. And then you add to it the credit spread and the liquidity premium. So when rates go down, definitely the 12% today at the 5% will become 10% at 3% interbank rate or the money market rate and so on. But there is also the credit risk premium cycle and the liquidity premium cycle. During when the economy is overheating and we have a booming economy, credit spread tend to come down. And during that time, central banks increase rates to cool down an overheating economy. The reason that credit spread declines because companies are doing very well, the economy is doing very well, they're growing, and there is ample of capital, and people are willing to lend buy these bonds or lend in the private credit market at lower and lower credit spread. And when rates go down, actually they get cut during the down phase of the cycle.
Does it come in a proportional way, or there is a proportion, or
does
it go like?
It's not scientific, but directionally yes. When interest rate decline massively, credit risk increase because they decline during a down phase of the economic cycle, so credit risk is very high. Think about COVID. If you lent or looked at the market begin April 2020, or you think about 2009, rates were very low. almost zero, like the prevailing rates in the market, the central bank rates, and which pushed SIBOR and LIBOR to very low rates. But credit spreads were very high. The high yield bonds, on average, they trade at around 400 basis point. At that time of the cycle, they were trading at 600, 700 basis point, because the distress in the economy. Is there a number, a proportion that you could use and put into your model? No, it's more art rather than a science. But you would expect it to behave that way. When interest rates start going down, they go down because the economy is slowing down, and when economy slow down means companies are not going to do as well as they were doing, then margins decline, their creditworthiness is worse, their cost of credit is higher. I think you need to look at several things. Definitely, you have to always monitor the high yield spreads. There are several indices you can monitor. You need to monitor also the credit default swaps. You have Saudi credit default swap. You can also get currently trading at around 70 basis points. So the credit default swap, meaning is the amount of money you pay to hedge against the default of the Saudi government. So to hedge against the risk of Saudi government defaulting, you pay 70 basis points. So that's the price of risk for the Saudi government. And then you can look at the credit default swaps for high yield companies, and that would give you a reasonable gauge for the private credit borrowers within the middle market. And you can add to it a certain premium for the SMEs and for an emerging market exposure, because a lot of these indices are developed market issuers are in them.
Yeah, thanks for the informative discussion. If you can speak a bit on the portfolio securitization for the private creditors, maybe during the discussion, so you also mentioned, which is the case, the account sukuk is not tradable. I'm not aware, and I'm not sure from a regulatory perspective, of any precedent case where private creditor in the market has a tradable portfolio, where they can basically sell their portfolio to someone else. My understanding, even in the ICE banks, it's not very common to sell such portfolios. So the question would be, or maybe part of it is, as the private credit industry or asset class is being developed, do you think that would be a common practice, especially in Saudi, because globally I think it's the case.
We're currently in discussion with a non-bank financial institution or to offload their portfolio, and it is. I'm not sure if there were transactions before. Probably there is, but I'm not aware of. But we're currently in discussion with one from the eastern province, and for them, they want to free up capital. They have capital requirement and constrained by Asامة, and they don't want to increase equity. So what they're thinking about, and we're exploring with them, is to sell their portfolio, continue to be the servicer.
That's an important point.
That's very important and critical for us. and they would take that capital and recycle it. Pricing is something we are discussing with them. I'm not sure if we're going to reach an agreement on the price, but I'm sure others are also engaged in different conversations. It's a matter of time until someone does it at scale. But also, like, you have SRC is buying from banks large portfolios of mortgages, and they just have securitized and done the first RMBS, Saudi RMBS, and so the industry is developing from various sides. Of course, we're not too keen on the SRC. It's not the return profile that our investors look for. It's more suitable for pension funds, for insurance companies, but the non-bank FIs portfolios that provide returns that are attractive to our investors is where we are more focused on.
Yes, please.
Can you hear me? Yeah. Thank you for the insights. I want to further question on the credit ratings. As you mentioned that in the Western world, they've started evaluating private credit, Moody's and S&P. But how do investors evaluate private credit products over here in terms of risk until that comes over here? I mean, since there is no credit rating at the moment, so if I am an investor, how would I gauge, what parameter can I use to gauge the risk?
You do credit analysis. I mean, there is we're lucky because we are under an umbrella of a bank. So we have a lot of capability and knowledge around assessment of credit risk and credit in general. Also depends on the deal. If you're doing middle market deal, you would hire PwC or KPMG or Deloitte to do an extensive due diligence that cover also the credit side. And on top of that, our friends at Sukuk, they have very strong credit assessment and scoring and analysis that we have did, and we think they're doing a great job as well. Maybe if you want to shed some more light.
Sure. So to answer your question, I think a very good start is where Saud mentioned having been in SAP Invest and having banking corporate experience kind of gave you that credit edge to actually start an asset management in private credit. But if I were to assume I'm an asset manager and I would actually enter private credit, I think dealing with the partner that is actually focused on that space and having a DD on that partner as a whole, of course, track record will always be beneficial to actually see what are the default rates since inception of that portfolio, and consider investing into that portfolio as a whole, and then diversifying your investment into each opportunity in case.
Assalamu alaikum. Thank you for your time and for your great insights about the private credit market. I have two high-level questions and one on the demand front. Based on my reading, I understand that the CMA is trying to push more companies to go IPO. Now, given the existence of the private credit, a lot of them could opt for private credit financing, and then therefore they could delay their opportunities to go public and list their company. So, do you see that could hinder the potentiality growth of the private credit in Saudi? And then my other question is more on the systemic risk. We all know during 2007 and 8, what drove the subprime was the creation of leverage and then slicing them up and then selling them to investors, which fueled the real estate. Now, there are a few people now that talk about similar patterns being in the private credit, where a lot of people now moving into the private credit that's less regulated. Do you see any systemic risk going forward that's giving the limited regulation in this space? Thank you.
في السعودية I don't think so, because it's very very small. 7 billion is very tiny, so it doesn't create any systematic risk for the macro level. Second is that there is still few players and still discipline in the industry, and one of the reasons I stressed on the risks and the pricing discipline is I want to make sure that we don't become complacent, and we have very fast growth at the cost of discipline and underwriting quality. Globally, I totally agree. I mean, it's I started my career at the end of 2005, and my first job at Samba was in treasury at the structured credit and emerging market investments. Structured credit, we used to, I was just a junior analyst, the team that manages the banks, CDOs, CLOs, CDSs, and credit exposure. And in 2000 so everyone was growing in that space, in the structured credit, which is the credit derivatives, where the subprimes, the asset-backed securities, and the subprime was in. It feels a lot the same, honestly. When I read about the global private credit, when I sit with the investors and the way they talk about it as the magic solution that gives you 10%, 15% returns at very minimal risk. So that worries me, and the subprime crisis started, actually, we started feeling cracks in the market in the summer of 27. There were 2 hedge funds run by Bear Stearns that blew up, and equity markets were rallying like there is nothing and no issues whatsoever. And I remember during that time, it was at least at the desk, it was very bad times. And I remember my boss at that time, we had a meeting with the treasurer, and my boss had planned his summer holiday, and he had to cancel because there were like the market. There was already dislocations and problems in the market, but people were thinking that it's only about subprime and not even, it's a small segment of the overall mortgage market. Subprime at that time was around 10% of the overall US mortgage. 90% is prime loans. And most people were thinking that it's going to be contained and there's not going to be a spillover in the economy. Fast forward till September 2008, and you had a complete shutdown of the economy. I'm not sure we would have something similar. These are once in 100-year events. Is that going to be the same magnitude? But probably it's not going to be a pleasant outcome for private credit in developed markets because of the complacency and the amount of frauds we started to read and hear about. But in Saudi, it's totally different. It's totally different. Not because we are in Saudi, or not because we are investing in the space, because it's totally different. There, it's more sponsored loans, very low quality, high risk businesses. Here, it's more SME, providing financing solutions to borrowers that do not have access to banks, either because banks do not want to service or are unable to service. So the dynamic is totally different. And the size is much smaller. So 7 billion is not going to cause a systematic risk.
Thank you, Abu Saud. I think unfortunately we reached our time. Thank you, Abu Saud, for an insightful discussion. Thanks to everyone who engaged. Thank you for your questions.